Here's something that should make you stop scrolling right now. Silver is sitting at approximately $80 an ounce today, April 23rd, 2026, and I'm about to tell you that $80 might one day look the way $5 looks to us now. Most people hear that and immediately check out. They assume it's hype, another clickbait price target from some guy on the internet. But here's the thing. I'm not asking you to trust me. I'm going to show you the math, the historical data, the institutional research, and the supply mechanics. And by the time this is over, $300 silver won't seem crazy. It might actually seem conservative. This is not financial advice. Everything here is for educational purposes only. Silver is extremely volatile. Always speak with a qualified financial professional before making any investment decisions. Let's build this from the ground up. What just happened and why the crash wasn't what you think? Here's what most people got wrong. Silver hit a nominal all-time high of $121.64 in late January this year. Then in just 10 weeks, it crashed 44%, all the way down to $67. Now it's recovering, hovering near $80. If you saw that crash and thought, see, silver was a bubble, let me explain why that interpretation misses the point entirely. That crash was not caused by a change in silver's fundamentals. It was caused by financial market mechanics, margin calls, leveraged liquidations, algorithmic stop losses, paper contracts being unwound at massive scale. The physical world didn't blink. Mines kept running, factories kept consuming, solar panels kept getting installed, data centers kept getting built. In fact, the physical silver market ran an estimated 67 million ounce deficit in 2026, right through the paper price collapse. What you witnessed wasn't silver topping out, it was silver experiencing a violent paper correction on top of an unresolved physical shortage. History tells us exactly what happens next in that situation. Where we are right now, today's price action. As of today, silver is trading at approximately $79.50 to $80 per ounce. That's slightly off recent highs near $82, and the reason is specific. Over the weekend, new naval confrontations flared in the Gulf of Oman. The U.S. Navy seized an Iranian-flagged vessel. Iran reasserted positioning near the Strait of Hormuz. The fragile ceasefire that was building last week got complicated again. Here's the chain reaction every time that happens. Hormuz tensions to oil goes up. Inflation expectations rise. Fed expected to stay tight. Silver faces headwinds. But here's where it gets interesting. Last Friday, Iran's foreign ministry signaled the strait would remain open during the ceasefire period. Oil dropped over 10% in a single session. The dollar gave back nearly 3% from its 10-month high. 10-year Treasury yield fell to 4.23%, and for the first time since early March, the bond market started pricing in Fed rate cuts before end of 2026. Silver's response? It shot from $77 to over $82 in days, a 6% move on macro expectations alone. What you're looking at right now is a temporary pullback inside a larger macro transition that is slowly but unmistakably moving in silver's favor. The core mechanism, how this market actually works. Most people never get this explained clearly. Let me fix that. Silver doesn't pay interest, it doesn't pay dividends, it just sits there. So its primary competition is yield-bearing assets, treasury bonds, money market funds, interest-bearing deposits. When the Fed raises rates, bonds pay more and institutional money rotates out of silver. When the Fed cuts, bonds pay less and money rotates back into hard assets like silver. Layer the dollar on top. Silver is priced globally in U.S. dollars. A stronger dollar makes silver more expensive everywhere else on Earth. Demand drops. A weaker dollar makes silver cheaper internationally. Demand rises. Right now, both levers, interest rates and the dollar, are moving in silver's favor. Slowly, with volatility, but moving. And underneath all of that is something most analysis completely ignores, the growing disconnect between paper silver and physical silver. COMEX registered inventories are at critically thin levels. China, the world's largest physical silver consumer, tightened export licenses in January. Physical lease rates spiked to historic highs earlier this year. Every time in history the paper market has diverged significantly from physical reality, the paper price has been forced to reconcile, and that reconciliation tends to be violent. The supply story. This is the most important part. Most people don't realize this, but the Silver Institute, the official global body tracking silver supply and demand, just confirmed that 2026 marks the sixth straight year of market deficit. 6 straight years where the world consumed more silver than it produced. The shortfall this year alone, approximately 67 million ounces. The cumulative drawdown since 2021, over 762 million ounces pulled from above-ground stockpiles. And here's why supply can't just fix itself. Roughly 70 to 80% of global silver is mined as a byproduct of copper, zinc, and lead operations. The decision to produce more silver isn't driven by the silver price. It's driven by the economics of the primary metal. You cannot flip a switch on silver supply.
Total mine production in 2026 is expected to grow only about 1% to roughly 820 million ounces. Total demand is running close to 1.05 billion ounces. The math simply doesn't close. And demand isn't slowing down, it's accelerating, driven by 3 structural forces. Solar energy, consuming 194 to 230 million ounces per year. Global solar installations growing at about 15% annually. Electric vehicles. Each EV uses roughly 1 to 2 ounces of silver. With global EV production approaching 15 million units this year, that's up to 30 million additional ounces of demand annually. Artificial intelligence. AI data centers require silver in servers, power distribution, and cooling systems. Silver is the best electrical conductor on Earth. And because silver represents such a tiny fraction of data center construction costs, industrial buyers are essentially price insensitive. They buy what they need, period. That's the most bullish type of demand a commodity can have. None of these 3 drivers is cyclical. They are structural, irreversible, and accelerating. The price targets, built from math, not fantasy. Scenario 1. $150 to $300. The gold to silver ratio currently sits at approximately 60 to 1. Gold is trading near $4,800 per ounce. Historically, during commodity bull markets, this ratio compresses dramatically to 32 to 1 in 2011 to 17 to 1 in 1980. If gold stays at $4,800 and the ratio simply returns to 40 to 1, the lower end of its long-term average, silver is at $120. If gold moves to $6,000 and the ratio hits 30 to 1, as in 2011, silver is at $200. If gold reaches $8,000 with a ratio of 35 to 1, silver is at $228. This isn't speculation. This is documented, historically proven ratio behavior, and it's where Bank of America's published targets of $135 to $309 and Citi's range of $150 to $170 are coming from. Scenario 2, $300 to $500. This layer requires currency debasement and sovereign debt pressure. U.S. national debt has now exceeded $38 trillion. The IMF recently warned that the explosion of U.S. debt is eroding the safety premium of Treasury bonds. When market participants begin questioning a government's ability to service its debt without printing money, hard assets reprice fast. If the dollar weakens 20 to 30% in purchasing power over the next 5 years, gold moves to $8,000 to $10,000. Silver, at a 25-to-1 ratio, historically achieved during acute monetary stress, lands at $320 to $400. Add the physical squeeze tightening further as stockpiles thin, and $300 to $500 is the logical output. Scenario 3, $500 to $700. This is the scenario most analysts won't say out loud. Let me walk you through it. In 1971, silver was at $1.50. By January 1980, it hit $49.45. That's a 3,200% move in 9 years, driven by Nixon closing the gold window, an oil crisis, persistent double-digit inflation, and a Federal Reserve that had lost credibility. Here's the thing. Consider what's similar today. The dollar hasn't been on a gold standard since 1971. Oil supply is actively being disrupted by the Strait of Hormuz conflict. Inflation has been persistently above target for years. The Fed is navigating between recession and inflation with declining public confidence. U.S. debt is at levels threatening long-term dollar credibility. If this cycle simply replicates the percentage move of the 1970s from silver's 2020 low of $12, we're looking at a 3,000% move. That's $360 from the starting point. We're already at a 900% move from $12 to $121. The 1970 cycle ran 3,200% start to finish. We may not even be at the midpoint. For $500 to $700 to materialize, 4 things need to converge: a genuine dollar confidence crisis, physical stockpiles hitting critical thresholds, the Fed being forced into aggressive rate cuts, and sustained geopolitical instability maintaining inflationary pressure. Conditional, not a prediction, but also not crazy. In 2020, if someone told you silver would hit $121 in 5 years, you would have called it hype. And yet, here we are. The risks, because honesty matters. Silver's volatility is extreme. We already saw a 44% crash this year alone. Even inside a genuine long-term bull market, silver regularly corrects 30 to 50%. The geopolitical situation could resolve faster than expected. The Fed could turn unexpectedly hawkish. A global recession could temporarily crush industrial demand. Solar manufacturers are actively trying to reduce silver content per cell, and timing risk is real. You can be right about the thesis and still get wiped out if volatility takes you out before the move arrives. Manage your risk. Size your position appropriately. Never invest money you cannot afford to lose. Silver, for the thesis we've laid out today, is not a trade. It's a long-term conviction held through volatility. That's a very different psychological undertaking. So bringing it full circle, today at approximately $80 per ounce, silver sits 34% below its all-time high, with the same structural supply deficit intact, demand drivers accelerating, the macro environment moving in its direction, and institutional price targets from the largest banks on earth ranging from $135 to $309. The conservative scenario, built purely from gold-silver ratio math, takes you to $150 to $300. The expansion scenario, currency pressure and debt dynamics, takes you to $300 to $500. The extreme but historically grounded scenario takes you to the zone most people won't say out loud, $500 to $700. Not as a guarantee, not a prediction, but as the mathematical output of conditions that have precedent and are already partially in motion. So let me ask you the same question I started with. The physical world is running short of silver. Industrial demand needs more of it every year than mines can produce. The macro environment, despite today's noise, is moving in the direction that historically launches hard assets into historic moves. At $80 an ounce, with all of that building beneath the surface, are you early or are you already too late? that might be one of the most important financial questions you consider this decade. If this gave you a framework the mainstream financial media won't give, hit subscribe. Share this with someone who needs to understand what's actually happening in the silver market. And drop your price target for silver by end of 2027 in the comments, because the people paying attention right now are going to have a very different story to tell in 2 or 3 years. See you in the next one.